I welcome from Dubai, Bhavik Mehta, Deputy Head Research of Investment Products at Century Financial. Welcome and thank you for being with us and Happy New Year. Do you think that 2025 represented a changing point in the global economic cycle, or it was a continuation of uncertainty that we saw at the beginning of the year because of geopolitical tensions and trade wars?
Well, this year indeed was a year where we saw a lot of contradictions, a lot of volatility, and also the continuation of different uncertainties that were happening in the market in 2023, 2024. Now, interestingly, what has happened this year is people have not just readily put money in the AI technology stocks as well as the European stocks, but we've also seen rapid gains in safe havens like gold. Silver, which is said to be one of the biggest industrial consumers as well as impact from the different tariff related wars that is going on, has rallied by something like 150%. So 2025 interestingly happened to be a year where commodities have literally outperformed all the equities. European equities have outperformed US markets. So pretty much I would say a lot of uncertainty that was there in 2024 getting forward to 25 as well as the next year.
In terms of how sensitive markets are for what we saw the end of the year on the interest rate in the US, do you think that markets are still ahead of central banks in pricing cuts?
Very much rightly pointed out so by you. There is still optimism about regarding the market participants that Fed could again aggressively cut next year. But the problem over here is the nature of the markets. Ever since last couple of years, markets always tend to be more optimistic than the what the underlying data or even the Fed projections are showing. So the latest FOMC meeting, if we saw, the dot plot pretty much says that we're just going to have one interest rate cut by the end of the next year. But you look at what the futures market are pricing, bare minimum of 50 to 75 basis point. That's something like 2 to 3 interest rate cuts. So the over optimism is still there, and people are still putting money in the tech AI wave as far as the trends are seen.
In contrast, how do we see the balanced growth globally between the US, Europe, and emerging markets?
Emerging markets have done superbly splendidly this year. So I think SPX gave something like 18 to 20% so far this year. Nasdaq is giving 20 to 23%. Something like Nikkei, Japanese stocks, they are giving 48 to 50%. We've had good inflows into Brazilian equities as well. Hong Kong has, with its 25 26 percent gains, has outperformed the overall US and the European markets. So one of the main reasons, of course, for this has been overall weaker dollar trends that we have seen so far this year. So a combination of weaker dollar along with expectations that again Fed could be on the money pumping drive next year has basically given some sort of support to the emerging market players and the indices.
Thank you very much for being
Thank
with
you.
us and for your insights. Always happy to have you. This is all the time we have. We were happy to discuss global markets with you, and Happy New Year.